Florida in 2026 is no longer just a retirement haven. It has evolved into a global financial fortress. We are witnessing the Wall Street-ification of the South. The investment strategy has shifted from retail-driven buy and hold to institutional-grade portfolio scaling. We are analyzing the migration of over $100 billion in AUM from the Northeast and California into the Miami-West Palm Beach corridor. The strategy now focuses on the inward migration multiplier. For every high-net-worth individual moving to Florida, we see a demand for 15 to 20 service and support jobs. This creates a massive missing middle housing crisis. Investors are no longer just looking for luxury condos. They are hunting for multifamily units in sub-primary markets, like Hialeah, Homestead, and Hollywood. We use the net absorption rate formula to calculate the viability of these areas. NAR equals S. Total units occupied at end, total units occupied at start. New supply. In 2026, the NAR in South Florida is outstripping supply by a ratio of 3:1. The days of easy 8% cap rates in Miami are over. In 2026, we are seeing cap rate compression down to 4.5% or 5% for prime assets. Investors are forced to pivot toward Value Add 2.0. This isn't just painting walls, it's resilience upgrading. We calculate the return on resilience, ROR. If you invest $50,000 in impact windows and roof hardening, and that reduces your insurance premium by $8,000 annually, your internal rate of return on that specific capital expenditure is massive over a 10-year hold. We analyze the debt service coverage ratio, DSCR, in a 2026 environment where interest rates have stabilized but remain higher than the 2020 lows. An investor's strategy must prioritize positive leverage. Cap rate. Cost of debt. If your cost of debt is 6.5% and your cap rate is 5%, you have negative leverage, and you are essentially paying for the privilege of owning the asset. We'll explore how to bridge this gap using seller financing and assumable mortgages, which are the golden tickets of 2026. By January 2026, the grace period is over. The Structural Integrity Reserve Study, SEERS, is no longer a future threat. It is a present reality. For decades, Florida condo boards voted to waive reserves to keep HOAs low. In 2026, that is illegal. Buildings 3 stories or higher must now fund 100% of their structural reserves for items like the roof, load-bearing walls, and plumbing. We analyze the reserve funding deficit, RFD. Many buildings from the 70s and 80s are facing gaps in the millions. For an investor, this means the cheap $300K condo in Hallandale or Brickell might come with a special assessment of $150K. We use the linear depreciation model to forecast these costs. Annual reserve requirement equals estimated replacement cost, current reserve balance. Remaining useful life. If the remaining useful life of a 2MR roof is 2 years and you have $0 in reserves, the math is brutal. In 2026, we don't buy units. We buy balance sheets. In 2026, the milestone inspection has become the ultimate go-no-go gauge for lenders. If a building is 30 years old, or 25 if within 3 miles of the coast, it must pass a Phase 1 structural inspection. If substantial damage is found, Phase 2 begins. For the investor, a failed milestone is a catastrophic event. Most traditional lenders, Fannie Mae, Freddie Mac, will blackball the building. This creates a liquidity trap. Owners cannot sell because buyers cannot get mortgages. This is where cash is king investors thrive, buying distressed units at 40% discounts from owners who can't afford the coming repairs. However, you must calculate the total cost of ownership, TCO, factoring in the cost to bring the building back to 2026 code standards. We analyze the deferred maintenance ratio as a key indicator of risk. Section 718.1117 of the Florida Statutes is the most discussed law in 2026 boardrooms. This is the condo termination play. When a building becomes too expensive to repair, developers move in to buy out the entire structure. The 80% rule allows a developer to force a sale of the whole building once they own enough units. In 2026, we are seeing a bulk buy frenzy. Investors are identifying zombies, buildings with high assessments and prime waterfront land. The strategy is to buy 5-10 units, gain board control, and flip the entire lot to a developer for a 300% ROI. This is the industrialization of gentrification, and it is the primary way Miami's skyline is being cleared for the next generation of ultra-luxury towers. In 2026, insurance is no longer a variable cost. It is a binary gatekeeper. Private insurance carriers in Florida have adopted a no-sirs, no-coverage policy. If a building has not completed its structural integrity reserve study or shows a funding gap of more than 30%, the master policy is either canceled or moved to Citizens at a 300% premium. We analyze the risk-adjusted premium, PRR equals BX, 1 plus SS risk, X, 1 plus M, age. For an investor, a building that is SIRS compliant in 2026 carries a liquidity premium. These units sell for 20% more because they are insurable and mortgageable. We are seeing an insurance arbitrage strategy. Investors buy non-compliant units cash, fund the repairs through board activism, and then refinance once the building is cleared and insured by a private carrier, instantly capturing equity. What happens when a condo board becomes paralyzed by the cost of 2026 repairs? Enter court-appointed receivership. In 2026, Florida courts are increasingly stripping power from elected boards that fail to implement CERA's mandated assessments. A receiver is a professional appointed by a judge to run the building like a business. The receiver's only goal is compliance. They do not care about the residents' fixed incomes or personal hardships. They have the legal authority to impose emergency assessments and foreclose on units in as little as 60 days if unpaid. For the strategic investor, the receiver's list is the ultimate source of distressed assets. We analyze the receivership discount factor, where properties under court control often trade at 50 cents on the dollar. However, the exit strategy requires the investor to have the capital to pay the receiver's assessments up front to clear the title. In 2026, we operate in a binary insurance market. A property is either insurable by private carriers or Citizens dependent. This distinction creates a massive valuation gap. We are tracking the resilience premium, RP3. RP equals V/hardened, V/legacy, where V/hardened is the value of an asset with a fortified gold designation and V/legacy is a standard 2000s build. In 2026, this premium has widened to 15 to 18% in coastal markets like Sunny Isles and Naples. Investors are now performing insurance arbitrage, buying high-risk assets with zombie policies. They are implementing envelope hardening, secondary water resistance, hurricane straps, and Class 4 impact glass. They are successfully migrating the asset back to the private market. This move typically reduces the expense ratio by 30% overnight. It directly boosts the net operating income, NOI. The 2026 investor doesn't just look at aesthetics. They look at the structural health monitoring, SHM systems. We are seeing the first residential applications of ultra-high-performance concrete, UHPC, in structural connections for high-rises. This material has a compressive strength 4x higher than traditional concrete. It is virtually impermeable to saltwater intrusion. Additionally, we analyze the smart envelope. In 2026, Class A buildings are equipped with fiber optic sensors embedded in the facade. These sensors detect moisture intrusion and vibration anomalies during storm events in real time. For the institutional investor, these sensors provide the data needed to lower the risk-adjusted discount rate. Russell, ERRF, Beta, M, F, Delta, resilience, where tau should be for tau, resilience, is the discount granted by capital markets for assets with real-time health data. We'll show you how to audit these systems during your 2026 due diligence. In 2026, GRSB, Global Real Estate Sustainability Benchmark, has shifted from intent to performance. Institutional funds are no longer buying green, they are buying resilient. We analyze the return on resilience, ROR. Properties with high GRESB scores in Florida are attracting green debt, loans with interest rates 25 to 50 basis points lower than market. This is the ESG arbitrage. By retrofitting a building to 2026 resilience standards, you aren't just saving on insurance, you are lowering your cost of capital. We will break down the nature-based solutions, SB 302, like mangrove restoration tax credits. Smart developers are using these to offset infrastructure costs in 2026. In 2026, the most important number in a property listing isn't the square footage. It's the BFE, base flood elevation. FEMA's 2024-2026 map updates have reclassified over 16,000 parcels in Palm Beach County alone as high risk. This has created an elevation arbitrage opportunity. Investors are identifying properties in X zones, low risk, that are adjacent to high risk AE zones. These properties are seeing a safe haven appreciation of 12% annually. Their neighbors in AE zones are seeing price stagnation. We calculate the elevation value gap, EVGs. EVG, EGs, frac, V, high ground, V, low ground, V, low ground, times $100. In 2026, for every foot of elevation above the BFE, we see an average property value increase of $3.50 per square foot in the rental market. Tenants prioritize lower insurance-driven rent surcharges. Traditional indemnity insurance can take 6 to 12 months to pay out after a hurricane. In 2026, savvy investors are using parametric insurance as a top-layer solution. Unlike traditional policies, parametric insurance pays out based on a trigger event. The payout happens within days, not months. This provides the emergency capital needed to prevent building decay. It helps pay for security or keep the mortgage current while waiting for the larger claim. We analyze the liquidity survival ratio, LSR TARS, LSR isupos frax text parametric payout, text cash reserves, text was 6 months, debt service, plus emergency repairs. In the 2026 market, properties with an LSR 1.0 command a higher resale price. The risk of foreclosure post-catastrophe is effectively eliminated. The 2026 Florida legislative session introduced SB 992, a game-changer for commercial and multifamily investors. This bill offers tax credits of $0.50 to $2,000 per square foot for 5 years for resilient buildings. These buildings must achieve platinum or gold LEED certification with a resilience pathway. In 2026, the 1031 exchange remains the most powerful tool for capital preservation. However, the 45-day identification window has become a high-velocity challenge due to tight inventory in the resilient sectors. We are seeing a trend of vertical to horizontal swaps. Investors are selling high-maintenance coastal condos and rolling the equity into single-family built-to-rent portfolios or industrial flex spaces. To fully defer capital gains, the replacement property must be of equal or greater value. In 2026, the safe haven play is to identify the replacement before listing the relinquished asset. We'll cover the Reverse 131, a 2026 favorite for institutional players who have the liquidity to close on the new asset first. January 2026. Data shows that ultra-luxury sales have hit a 4-year high. This is the wealth harvesting phase. High-net-worth individuals are moving from appreciation mode to liquidity mode. The 2026 exit strategy for luxury estates focuses on multi-generational appeal. Properties with guest houses or ADUs are selling 30% faster. For the investor, the key is the absorption rate. In micro-markets like Star Island or Gables Estates, the absorption rate is currently favoring sellers, but the window is narrow. We discuss how to use off-market auctions to create bidding wars among the global elite moving to Florida this year. For international investors, the 2026 exit is governed by FIRB-TA. With a stronger dollar and surging values, the 15% withholding can be a significant liquidity hit. We analyze the qualified substituted entity strategy to manage this withholding. In 2026, savvy international owners are seasoning their assets to qualify for the $250K/500K tax-free gain. In February 2026, we are seeing a mass migration of capital from the saturated coast to the growth corridors of Tampa and Orlando. While Miami's luxury inventory is at record highs, Tampa's median price has stabilized around $400,000. Investors are executing yield arbitrage. By selling a low cap rate condo in Brickell and buying a single-family home in Lake Nona or Westchase, they are capturing yields closer to 5.5%, 6%. If the market migration multiplier is greater than 1.3, the rotation is mathematically superior. In 2026, Orlando's diversification into tech and healthcare provides a hedge against the tourism-only volatility of the past. For the ultra-wealthy, the exit from Palm Beach is a move north to Martin County. In 2026, the luxury threshold here has risen to 3.1 M, with record-breaking Uber luxury sales reaching 8.3 M+. The exit strategy here is equity preservation. Investors are selling older Palm Beach mansions and building custom hurricane-hardened estates in Stewart or Jupiter Island. In 2026, Martin County is the silent winner of the Florida wealth migration. Finally, the 2026 exit is increasingly being facilitated by institutional buy boxes. If your property meets the Modulo 3 standards, you have an instant exit. In 2026, properties with an institutional liquidity factor greater than 2 sell without ever hitting the MLS. In 2026, real-world asset, RWA tokenization, has moved from experimental pilots to a trillion-dollar market. For the Florida investor, this means a property is no longer a single, illiquid block of capital. It is now a series of digital tokens on a blockchain representing fractional ownership. This solves the liquidity gap we discussed in Module 2. If a building requires a 100K assessment, owners can tokenize a percentage of the building's future equity to institutional pools to cover the costs without taking on high-interest debt. We analyze the tokenized yield spread, T-STOSARS. In 2026, on-chain yields are averaging 150 basis points higher due to the elimination of traditional intermediaries through smart contracts. The legal landscape was transformed on January 1, 2026, with the implementation of the Clarity Act. This federal framework, combined with Florida's new strategic cryptocurrency reserve, has provided the legal certainty needed for institutional capital to flood the market. Under these 2026 rules, tokenized real estate is officially classified as a digital commodity when the blockchain system is mature. This allows for 24/7 secondary market trading. For you as an investor, this means you can exit 10% of your position at 2 a.m. on a Sunday if you need liquidity, a feat impossible in the 2024 market. We are seeing Florida emerge as the global hub for real asset structuring because of our pro-innovation leadership. In 2026, selling is the last resort. The rise of crypto-backed mortgages allows investors to use their digital assets as collateral for new property purchases. This is the non-taxable liquidity strategy. Instead of selling your Bitcoin and triggering a capital gains tax to buy a Miami condo, you lock your assets in a smart contract and receive a loan at a LTV of 50%. In 2026, fintech firms like Figure and Coinbase Institutional are offering these instant closings in Florida, reducing the closing period from 30 days to 48 hours. We use the collateral efficiency ratio, CER/DAWS. If CER were $1.5, borrowing against your digital assets is the superior move. In 2026, we no longer wait 10 days for a human appraiser to visit a property. Tokenized assets rely on real-time valuation oracles, RTVO. These are decentralized data feeds that aggregate millions of data points. We analyze the Oracle accuracy delta, our delta APR. In the 2026 Florida market, our delta AWAS has dropped below 1.5%. For an investor, this means your property's collateral value updates every 24 hours. If your property value spikes because a new tech headquarters is announced in West Palm Beach, your borrowing power increases instantly in your digital wallet. This is live equity, a concept that was impossible before the 2026 fintech boom. The 2026 market has democratized the billionaire's row. Through fractional equity flows, an investor can deploy as little as $500 into a $50 million waterfront development in Edgewater. The Citadel effect has solidified South Florida as the Wall Street of the South. In 2026, the market is no longer driven by speculation, but by institutional wealth inversion. High concentration of capital creates a 25% more efficient local economy. Follow the resilience corridors for strategic investments. The 2026 deadline for SERS has created a binary market. Buildings are either compliant or zombies. Do not buy units, buy balance sheets. Identify unfinanceable units for cash, buy regulatory flips. Target buildings for condo terminations with 300% ROI potential. Insurance is now a binary gatekeeper. 2026 legislation rewards hardened assets with a valuation premium. Every foot above base flood elevation adds value. Execute insurance arbitrage by retrofitting older assets. Harvesting wealth in 2026 requires moving to yield mode. Properties must fit buy boxes for instant liquidation. Use 1031 exchanges to rotate into built-to-rent portfolios. The Clarity Act of 2026 has made real estate liquid. Blockchain is the new title and governance system. On-chain assets yield more by removing intermediaries. Use crypto-backed mortgages to expand your portfolio. And that brings us to the end of this 2026 Florida Real Estate Masterclass. We've navigated through the regulatory storms of SARS, the technical revolution of the resilience premium, and the digital future of tokenization. But remember, information is only potential power. The real wealth is built by those who take action with the right data. I hope this blueprint serves as your compass in this new cycle. Before you go, if you found value in today's session, make sure to follow us on our social media channels. We are constantly posting real-time market updates, deep-dive legal analysis, and exclusive investment opportunities that you won't find anywhere else. Let's keep the conversation going. Join our community of resilient investors, and let's build the future of Florida together. We are South Florida Home Finder Team, and I'll see you at the next closing.